Welcome to the Cliffwater Direct Lending Index quarterly webinar for 3Q24. My name is Fran Byers. I'm the head of capital markets at Cliffwater, and I'm joined today by Steve Nesbitt, CEO and CIO at Cliffwater and creator of the Cliffwater Direct Lending Index. Cliffwater is an alternative investment advisor. We were founded in 2004, and we are active across the alternatives investment spectrum, currently advising on or managing $116 billion in alternative assets. Today, Steve's going to kick things off with a recap of the direct lending return performance in the third quarter. He's also going to introduce a couple of new sub-indices that we launched comparing upper middle market and lower middle market return performance. I will follow with a 2024 recap on trends within the direct lending market, as well as provide some insights for the year ahead. And so with that, Steve, please take us away.
Thanks, Fran. Just to review our suite of indices, if you look at this first slide, our flagship index is the Cliffwater Direct Lending Index, or CDLI. That's the broadest universe, all U.S. middle market loans. The start date for that index is Q4 2004. So we're basically at our 20th anniversary in terms of a returns series. So 80 quarterly numbers, and it's nice to mark that achievement. We developed shortly thereafter two sub-indices from the CDLI. One was the Cliffwater Senior Only Index, okay, eliminating the second lien and other subordinated debt securities from the CDLI, and the CDLI Venture-Backed Index, which just focuses on venture lending. More recently, we developed the CDLI Perpetual Index. The fastest growing part of the middle market direct lending industry is perpetual BDCs. We're going to have we had a paper come out a year ago on perpetuals. That's going to be updated in the next couple of weeks, so look forward to you seeing that. But that's an index basically of 20 to 30 perpetuals that are growing very, very fast. We launched last quarter with start dates going back in time, net of fee indices. So we had a lot of interest in the Cliffwater unlevered net of fee index. I will say that is, I won't cover that today, but that is published again. That's on our website. We did include carried interest this time in that index, and we restated the index, the history for carried interest. There's I won't go into it here, but we decided to include carried interest in that calculation. And also a levered net of fee index, which includes not only fees, but also leverage used by BDCs. So that was last quarter. This quarter, we're adding two new indices. We've subdivided the CDLI, or created a subset of the CDLI, just looking at upper middle market loans. These would be loans managed by lenders. We're basically focused on loans with borrowers with EBITDA greater than 100 million. And then the lower middle market subset of loans focused on lenders to companies with EBITDA less than $30 million. And we'll have information later, but I think you'll find this very interesting. I think we have a paper on the website that talks more fully about those two new indices. Just quickly, pretty quiet quarter for and year for the CDLI and middle market lending. Basically, it looks like in 2024, the CDLI index will earn roughly its yield. If you recall, let's go back 2 years. The CDLI was about 6%, underperformed its yield. That was 2002. That was the Russian crisis, and stocks and bonds, publics went down about 15 to 20%. At a positive return, but the CDLI under-earned its yield. If you recall, in 23, there was a bounce back, and the CDLI outperformed its yield. And then now in 2024, basically looks like the CDLI will earn its yield, maybe a little bit more. But if you look at the numbers over the trailing 4 quarters ending September, it continues to be strong income return, 12.21%, given the reduced Fed funds rate, the reference rate SOFR, and tightening spreads. Right now, we're looking at a yield of more like 11.5. Realized losses of 66 basis points. Long-term average, it looks like a far right-hand column, of minus 1.02%. So realized losses still are low, but they're starting to creep up a little bit. Total return 11.73%. So you compare those 4-quarter numbers against the inception. It's the last year has been better than average, as I would describe it, despite all the business press of problems with this, problems with that. It's been a really good year for the CDLI and generally for managed direct lending accounts. Looking at the bottom of this slide, basically this is I guess hedge fund folks would call it a carry trade. Basically, we're clipping high coupons, so we have very strong income return, but every once in a while, when we have a recession, we have small negative returns or modest negative returns. So this bottom chart is quarterly total return. The negative periods are few, and the severity is really a function of the severity of the recession. So going back to the left-hand side, the minus 6.68%, the worst quarterly return. Again, that's great financial crisis. That was a 3 sigma recession. You probably add to this minus 1.12%. So put them all in, you're looking at about a minus 8% return for a 3 sigma recession. If you look kind of midstream here, minus 18 basis points, minus 28 basis points, those were, I would consider, half sigma slowdowns with the oil crisis and the early in 2015, in 2010-11, that was the euro crisis, if you recall. But those were kind of half sigma, not positive returns, but basically zero returns. And then the COVID period, minus 4.84%. That's really a 2 sigma event, and very unusual, but it's still a 2 sigma economic event, and we were looking at minus 5%. In terms of performance and trying to explain performance, and particularly in relation to income and realized losses, I like this graph. It basically shows 2 things, which are the drivers of the CDLI. And that is first income. Those are the bars. You see it varies generally between 9 and 12%. Okay. And you subtract from that realized losses. So what we've shown here in the red line are realized losses. And those realized losses creep up during crisis periods, the financial crisis, the oil crisis, COVID, and Russia. focusing on the last 3 years, it has been kind of Goldilocks in the sense that yields have increased substantially, primarily because of increases in short-term rates. Also, earlier on, credit spreads were very wide. They've tightened up, but basically high yield, and then credit losses were extremely low. Even despite the Russian recession, credit losses, if you look trailing 4-quarter numbers, that red line is below the average 1.02%. So again, wind at the back of direct lending, high income, low losses. You got to deduct fees, but it's been a very good period for direct lending, and it looks like it'll continue into next year. And the only thing that has really concerned, at least us at Cliffwater, about the index and the performance of the index is that liquidity has, I wouldn't say it's dried up, but it's been below average over the last 2 or 3 years. And that's indicated by these bars, which measure the repayments or primarily loan repayments. So it's kind of the velocity of principal repayments. And notice that fell, and that's the result of basically a M&A market that went pretty much in the deep freeze. So that effectively raised the effective maturity from 5 years ago. It was on the order of got close to 2 years, jumped up to 5.61. It's gone down. Now it's at 4.04. So most people are looking for significant improvement in the number in the quarters ahead as M&A activity picks up. In terms of another measure of the health of this market, we focus on realized losses. We talked about that a couple slides ago. That's a flow statistic. This is what economists would call a stock statistic, which measures non-accrual loans. Basically, those are loans that have defaulted, okay, but have not been written off. So the realized losses have not been applied to these loans. They're just market value markdowns. So fair value markdowns. And if you look at this statistic, non-accrual statistic, I focus on is a percent of cost value. Basically, we're at very low rates. The average historical average has been 2.2%. So if you look at the left-hand y-axis, it shows 2%. 2.2, a little above that, but basically on the right-hand side, we're well below that. The current statistic is 1.3%, down from 1.6 last quarter. So non-accruals have been modest, which kind of reflects that the fact that realized losses are unlikely to be right now unlikely to climb a whole lot further on a go-forward basis. Also, recovery rates in this market are very consistent, averaging about 50%. If you recall, broadly syndicated loans are more like 70%. High-yield bonds are more like 35%. A lot of talk about PIK income over the last quarter. That seemed to get a whole lot of attention in the business press. We've been publishing PIK for a long time now, and basically it averaged about 5% over about 15 years until 5 years ago with COVID, and for obvious reasons, PIK income increased during COVID as a way to help companies that had basically locked down. Got as high as 12%. But since that time, it's kind of been a steady state of about 7%. And that's where it is today. The last quarter was jumped up to 8.6%. I think lenders got the message, and it's much more. It's gone down to it's basically post-COVID averages of 7%. So obviously, we're not concerned about PIK income. It obviously becomes an issue on a loan-by-loan basis, but overall, in the aggregate, doesn't strike us as a serious problem. Okay, couple new slides, and then I'll turn it over to Fran. So we have a paper out on a subject that we've been trying to tackle for several years, and that is performance of the upper middle market and lower middle market. So let me talk about the lower middle market. So depending on who you talk to, everybody agrees that yields on the lower middle market loans are higher. Okay, the question is whether defaults and losses offset that incremental yield. So we finally have a data series that helps us answer that question. So let's look at the lower middle market column and the upper middle market column. So we start with the lower middle market. So over a 5-year period, so this is 5 years ending September 30. I apologize, it's not on this slide, that date, but it's a 5-year number. Unlevered return 10.6. Okay. Notice that by about 67 basis points outperformed the upper middle market. Again, this is unlevered gross of fees. Okay. It outperformed. So how did it outperform? Higher yield. If you look at row 1, income return 69 basis points higher. Okay. And that wasn't given up by realized losses. Over this period, realized losses were only slightly higher for the lower middle market. Okay. 16 basis points higher. There were somewhat higher unrealized gains. Won't go into that. But basically, if you look at unlevered gross of fee, in the same methodology of the CDLI, the conclusion is, hey, lower middle market looks pretty attractive. I will say it's smaller. The upper middle market is much larger than the smaller middle market, but it does look like relatively attractive economics in the lower middle market. Okay, and it's a big but, when you invest with managers that operate in the lower middle market, okay, there are higher financing costs to leverage. So we look at the BDC cost of debt statistics, basically 41 basis points higher financing cost for smaller portfolio companies compared to larger portfolio companies, and also the fees are higher. Okay, I don't think it's that managers in lower middle market are more greedy. Probably it's more expensive to originate, underwrite, and manage companies with smaller EBITDA. But basically, those, in terms of implementation, those higher implementation costs basically bring both markets into parity at about 9.5%. So it's interesting, and our conclusion is, there's no reason to believe that one should overweight or underweight the lower middle market or the upper middle market more so than their market cap, if you will. And so the best, our takeaway is diversify. Basically, the CDLI as a composite index probably represents the best return risk trade-off. So if you're allocating, include lower, include upper, but don't include either of those at the expense of any other sectors. Just on this last slide here, I just want to break down the components here over time. So starting in the upper left hand side, total return, and again, this is before fee, unlevered return. So that the first four rows in the previous slide. So basically, if you look at total return, I don't know if it basically varies over time between the two sectors. I could dive into why, but I won't. But basically, they're kind of a match if you look at total return. On the right hand side, income definitely higher for the lower middle market. Bottom left, realized losses have been about the same, but particularly in recent years, losses have been significantly higher in the lower middle market, but that was offset in the 2019-2020 period. But they do differ over time. And finally, the bottom right-hand side, unrealized losses are about the same. It's the markups or markdowns and valuation basically parallel each other in the upper and the lower middle market. So with that, let me turn it over to Fran.
Great. Thank you so much, Steve. I'm excited to give you all just a brief market recap of the direct lending market as the year approaches a close. Overall performance definitely exceeded investors' expectations in terms of delivering not only a strong yield, but direct lenders managed to keep defaults low and successfully navigate through an elevated base rate environment, as Steve had showed earlier in the slides. When looking ahead to 2025, I would say the overall tone is that of cautious optimism, in that both new money deal flow is showing signs of a pickup, plus investors are showing a continued commitment to the asset class as they're anticipating they can still earn an attractive return as rates are no longer expected to fall as steeply as we had all projected 6 months ago. So on this slide, we want to highlight for you the deal flow and the fundraising environment for direct lending. Direct lending loan issuance is shown here on the left, going back about a decade, broken out between middle market borrowers and large corporate transactions. It was an extremely busy year. In fact, the numbers on the page scream record activity, particularly at the upper end of the market. And despite the fact that the public loan and the bond markets came roaring back to life in 2024, much of the large corporate flow that was feared to go back to the syndicated market did stay direct. Now, of course, it's crucial to point out that only half of 2024's volume was new money related, compared to the 80 to 90% new money market share that we saw going back in 2021 and 2022. Obviously, all year, lenders in the media have been highlighting the elongated repricing wave that took place, which did cause portfolio yields to tighten meaningfully, but in exchange for lenders being able to keep the assets for longer. In fact, Levfin Insights tracked over 330 repricing deals in the first 9 months of the year, with spreads being reduced from an average of 625 basis points down to 530 basis points. This was in large part driven by a supply-demand imbalance caused from yet another year of near record inflows, which outpaced new issue supply. So the chart on the right highlights how private credit is in its 4th straight year of near record inflows. Now, despite some recent base rate cuts and more modest cuts expected to come in 2025, investors are still showing support for the asset class, as they don't see the trajectory of rate cuts nearly as steep as they did 6 months ago. On top of that, you have direct lenders building new products like perpetually private BDCs and interval funds for the massive wealth channel. In fact, the growth that's coming to the space, driven by the wealth channel, is so pronounced that within the Cliffwater Direct Lending Index, we saw perpetually private BDCs AUM of 170 billion surpass that of the AUM of public BDCs for the first time this year. This is incredibly profound, given that the first perpetual BDC was only launched in 2021, while public BDCs have been around for 3 decades. But as these perpetual evergreen vehicles continue to raise capital in the wealth channel on a continuous basis, what we're seeing is the hold size within direct lenders' asset management platform is continuing to grow at a rapid rate. And so the trend of direct lenders moving up market and financing these mega deals are only going to continue in 2025. Flipping to the next slide, we can discuss why the expectations are for a pickup in LBO and M&A volumes in 2025. Chart on the left highlights that LBO issuance has been depressed in both 2023 and 2024 when we compare it to the 2 years prior. But on the right-hand side, what we can see is what the impact of this has been on private equity shops' inability to return distributions back to their LPs as a result of this dearth of exit opportunities. So in a bull market, for example, 2007 or 2021, we normally see private equity return roughly 40% of the capital back to their investors. In an average year, it's more of like 2008 or 2022, they return closer to 20%. But in 2023 and the first half of 2024, it's been pretty dire. It's only been around 10 to 11% of a return of distributions back to LPs. The high base rate environment, the high spread environment, coupled with the fact that the economy has been showing a deceleration in the growth rate, it's basically caused a wide bid-ask spread disconnect where private equity simply cannot get the valuations that they needed to make the returns work, which means we've seen the lowest levels of liquidity on record being returned to investors, mirroring what we saw post the Great Financial Crisis. And so we know there's a huge pent-up demand to transact, which is why many believe in 2025, we could see the trend be mirrored like we saw in 2010, when after a few years post-market dislocation, the M&A environment sprung back to life. We believe with the election behind us and with more conviction today versus 12 months ago that the economy will avoid a recession, most market participants believe M&A is poised to pick back up in 2025, and lenders are already telling us and signaling this, that they're seeing this early momentum in their pipelines. Moving to the next slide, we can discuss for you how the economics on loans have changed throughout the year and its impact for 2025. We discussed earlier how direct lenders had to reprice loans in their portfolios this year to stay competitive with the syndicated market. That rapid slide in spreads occurred for 6 consecutive quarters from March 2023 onward. The good news is we finally saw spreads hit a floor late this summer in August. And few direct lenders basically have sufficient pockets to stuff 450 basis point paper into their vehicles, and many can only do so much 475. And so we believe we've hit a floor and we're seeing it in the numbers. In fact, spreads have averaged closer to 525 basis points over the past 3 months between September and November. And all this data comes from Cliffwater. In large part, this is also being driven by a simultaneous fall in base rates. And so we've seen yields on first lien loans fall to around 10% from being over 12.5% several quarters earlier. When we look at that impact on dividend coverage ratios within the CDLI, we can see that it is starting to impact dividend coverage. It has been falling for 5 straight quarters, and it is now at the tightest level we have seen in over 6 years since 2018. A lot of the BDC research analysts are starting to come out and forecast that for those funds that are struggling with high levels of PIK income or heavy non-accruals, too many loans in distress, dividend cuts could be on the horizon next year. This is particularly true if we see base rate cuts continue in 2025 from the Fed. And so next year, that is a theme. We will continue to see bifurcated performance. Some managers will continue to drop spreads and face dividend cuts within their portfolios unless they use more leverage to keep the yields in their portfolios up. We will see other managers reaching for yield to try and keep their portfolio yields up. Either way, the theme of reduced dividends could surface at some point in the year with further base rate cuts. versus the sustained increase in dividends that we saw for the past 4 years. Flipping to the next slide, we show where spreads are moving across the different market segments within EBITDA. As spreads on bigger deals certainly fell fast this year, Steve highlighted, we've been getting a lot of questions from investors. Is lower middle market better? Is it time to pivot away from bigger deals to go smaller? I will say that the third quarter did show the strong value proposition of being in lower middle market. It exhibited much more stability in pricing and a nice yield premium relative to the bigger deals, which fell really quickly to the 475 area. However, people are pushing back on spread. In the fourth quarter, we actually saw middle market and upper middle market deals rebalance, and so spreads have moved somewhat more closer to parity with the lower middle market. This was helped by a slowing of repricings in the fourth quarter and a pickup in new M&A activity on bigger deals to help absorb the capital that's coming in. And in looking to the chart on the right, we can see that the higher risk ends of the market, like non-sponsored lending and ARR lending, also showed an uptick in spreads as direct lenders are looking to get paid for taking more risk. No surprise, we do believe the theme of direct lenders searching for enhanced yields will be apparent in 2025. And many folks are starting to venture into less trafficked areas of the market. ABF is a term that you're hearing over and over again, and you will continue to hear in 2025. People are looking at ABL lending, NAV lending, secondaries, you name it. These types of areas of the market could see more capital come in as lenders search for enhanced economics. Flipping to some performance metrics on the next slide, Steve highlighted for you earlier our new sub-indices for lower and upper middle market. One of the findings that I found particularly insightful was how these assets behave during periods of distress and workout. As I had expected to see, lower middle market assets do tend to show higher non-accrual rates. And we also found that through time, the recovery rates are also lower than bigger credits. However, the larger deals are showing a much higher share of their investment income on PIK. So this can imply a few things. First, we know that larger deals can receive and do warrant higher leverage levels. And so when base rates really shot up over the past 2 years, some bigger deals found themselves simply in unsustainable capital structures and ran into liquidity issues. However, those deals still had a lot of underlying enterprise value. And so sponsors stepped up and supported these larger deals, which is how we kept the non-accrual rate low. They put in additional capital, and then lenders did their part by allowing these loans to flip to PIK for some period of time to alleviate the cash burden on the companies. Also, upper middle market companies seem to have more PIK toggle features in them versus lower middle market. And the most recent quarter is showing that the level of PIK is starting to decline actually at the upper end of the middle market, in large part because base rates and spreads are starting to tighten. And because direct lenders are starting to say, okay, enough is enough on the PIK, it was getting to be a level that is just too elevated. You can also see that larger borrowers had more PIK in their structures, even during periods of benign macro environments, such as 2021 through 2023. And so they were structured that way out of the gate, most likely due to a meaningful amount of technology lending, which now drives 25% of the index versus being half of that 10 years ago. While lower middle market assets tend to lean on flipping to PIK more so only in a macro dislocation or a distressed environment like 2020 and 2024. Flipping to the next slide, either way for upper or lower middle market, the ability for direct lenders to flip part of the interest rate to PIK certainly was a huge driver to the lower default rate that we saw in the direct lending market this year. So looking to the chart on the left, the trailing 4Q default rate within our CDLI index is only 1.9% through September, far below what we're seeing in the public loan BSL market, which hit 4.7% in September. The forecasts for full year 2024 come from Fitch. They're anticipating that both loans and bonds could hit as high as 5.25% default rates through the end of the year. Although the high yield bond default rate appears pretty benign through September, so we would need to see a few really big deals go bad by the end of the year. Their forecast might come down from there, but the bottom line is direct lending hasn't seen that level of default rate since COVID. And barring any sort of exogenous shock next year, our expectations have been that the default environment is slowly reverting to the norm, which Steve highlighted earlier is around the 2 to 2.5% long-term average non-accrual rate in the index. In looking to the chart on the right, we can see the loss rates within the CDLI. They're pretty much going back to the average. So we took the 3Q and the 2Q loss rates. Instead of doing a trailing 4-quarter, I annualized them here for you. And so when you annualize them, they're getting back to that 1% area. Remember, when you're looking at managers' portfolios, newer portfolios that are less than 2 to 3 years old, they're gonna look pristine. And that has also been helping to keep the default rate low in our space, in our index, because as direct lending has been feverishly extending capital to new assets in the past year. Looking at the CDLIP, which is the perpetual index, which is comprised of exclusively BDCs, almost all of them with a less than 4-year life, we can see in the second quarter, the losses were non-existent. They were far below the other sub-indices. However, in 3Q24, we are starting to see a pickup in both realized and unrealized losses within this index, which again signals that some of the earlier 2021, 2022 perpetual vintages, they're going to start showing selective issues, just like all the other managers and the public BDCs that have been around for long periods of time. Flipping to the last slide, just giving you a quick summary themes of what to expect in 2025. So in the Cliff Notes version, we do see deal flow and new money lending opportunities picking up in 2025. We believe direct lenders will continue to maintain an edge in financing M&A transactions, despite banks aggressively trying to compete. We do see the BSL market continuing to be aggressive, trying to reprice deals away from direct lending. They certainly will win some of those deals away, no doubt. It will warrant direct lenders to work that much harder to replace those assets in 2025. But on M&A related deals, on acquisition related financings, direct lenders will continue to have an edge. Even though a Trump administration could be a positive for the banks, people are speculating, oh, could they make regulation less of a concern for the banks? Will it make banks more competitive? We believe banks have not been living on the edge of regulation for some time. They are too far out of the game to win back the market share that they lost. Direct lenders are too fast, they're too flexible, and they're too flush with capital. Hold sizes are way higher today versus 5 years ago, and that has been a fundamental game changer for the space. We do expect the market will remain competitive. Direct lenders are going to inevitably reach for yield. They're going to dabble in new asset classes outside of what they know, which is both an opportunity, it is also a risk. But overall, we do expect the default, recovery, and loss rates are going to revert to the long-term average. Of course, caveating and barring any sort of exogenous shock, which I can't predict. I don't think Steve can predict either. So we won't try and predict. But thank you for your time today, Steve. Back to you to sign off.
Hey, thanks, Fran. Thanks, everybody, for your support of our index. If you have any questions, please reach out to us. Finally, I wish you a very happy holiday season, and we'll talk again in 3 months, if not earlier. Thank you.